All right, so my name is Travaris Tut. For those of you who did not see the last video, I'm doing a video series on home buying, home selling, home investing for real estate. My name is Travaris Tut. I'm a realtor here in Florida. I specialize in the Jacksonville, Florida area. I help investors, cash investors, find off-market, discounted, and wholesale properties. So I wanted to talk to you about something very important for those of you who are not purchasing homes with cash, but you're planning on getting a loan to purchase a house. 3 reasons why you should not purchase a vehicle unless you're purchasing it cash. But if you plan on getting a loan, why you should not do that before you purchase a house. Obviously, you need transportation to get to work, right? Obviously, you need transportation to get around. I understand that. But typically, you know, if you are young, you're working, maybe you were living with your parents in the beginning, you know, in your teenage years, that should be a time where you're saving up money. You're not just buying shoes, buying clothes, but you're saving up money to buy a car cash so that you can get around in the meantime while you build your income up, build your capital up, so that you can buy a house first. And the reason why is, one, cars immediately depreciate when you drive them off of the lot. So if you buy a house, or you buy a car, you buy a car and you get a loan on that vehicle, well, the amount that you just purchased that car for, let's say it was $20,000, now it's only worth $16,000 when you bring it back, if that. So cars depreciate, so it's not really an investment. A car is not really an investment unless you have someone who understands how to go to auctions and they know how to buy cars at discounted prices and they know how to fix them up and flip them. That's a good business. But for somebody who is buying a car off the lot, whether it be brand new or used, that price for that vehicle when you buy it on the lot is marked up to a point to where when you drive it off the lot, you basically just lost money. So that's one reason, and the reason why that applies to this conversation is because a house, on the other hand, typically will appreciate in value. Now, can some of them depreciate? Of course. If it's in a bad neighborhood, if it's in a neighborhood where nothing is gonna be built there, it's in, you know, maybe it's a shack. I mean, typically if you're gonna purchase a home, you know, and you're gonna spend a good amount of money, you're talking about something you plan on living in, you're gonna, a wise thing to do would be to buy in a neighborhood that is up and coming, maybe is growing, or maybe it has grown. Those will appreciate in value. More will be built around there. You know, with houses, they can, of course, be stagnant as far as their value. But one thing you're not gonna have to worry about for the most part is them depreciating immediately when you purchase it. I mean, when you purchase that house, it's not like you can't go back and sell it the next month and maybe come up a few $1,000s. You can do that, especially if you're buying a brand new house. If you buy a brand new house, that house is going to appreciate, because if that community has more houses in it, the less houses that they have, all new home builders go up on their prices. So the same house that you buy that's $200,000, once they start a new phase in that same community, that same house is going to be $220,000. So your house now is worth $220,000. So it's an actual investment. Now, that doesn't mean that you don't have any liability. I mean, if you bought it with a loan, you're gonna have to pay that loan off. That is true. But at the same time, the more you pay that loan down, you have equity. You don't build equity really into a car like that. I mean, if you pay it off and you sell it, you might make some of your money back. And then the other good thing about houses is that typically mankind wants to revitalize. Mankind wants to beautify. So therefore, when you look at communities that are even maybe they're impoverished, maybe they're rough neighborhoods with houses that were built, 100 years ago, and they're just falling apart. Well, what you will see in any major city is that the city planners are going to go in and they're going to look at these communities and they're going to say, hey, we want to revitalize this community. How can we get investors to invest into this community to make it something so it's not an eyesore in our city? And so sometimes that could be a bad thing for people who are already living there, people who are renting, but it can still be overall a good thing for the whole city, because now you're making that community into something, especially if the people already in the community start to beautify it themselves. So with that being said, even communities that quote unquote are depreciating, they will eventually get to a point where people say, hey, we have to turn this around. So that's why real estate versus buying a car is going to always pan out to be better. With that being said, that is one reason you don't want to invest into a car before you invest into real estate. Two, cars, typically if you buy or you get a loan, especially if you go through the dealership, and they send out your credit and your profile to 100 banks, your credit score is immediately going to drop when they do that, because you got all these people checking your credit for one. And then once you buy the car, now you have this new debt, and your credit score is going to drop because of that as well. So once you pay on it for maybe 6 months, your credit score will go up. It is a good tool to build your credit if you pay on time. That is true. But here's the issue. So that was kind of the second reason, because it does mess with your credit. And typically if you go through the dealership, you're going to have high interest rates if you're not going through your bank or you're not going through a credit union. But how that ties into the third reason is because when you're dealing with debt, so you got this new debt, you got $20,000 or $15,000 in debt with this car loan. Well, what just happened is your debt went up, but most times your income is going to stay the same, or if it did go up, it did not go up to the point where that loan, that new debt that you get makes a difference. So you're talking about debt to income ratio now, and that's exactly what lenders look at when they're deciding how much of a house you can afford. So if you want to get a house in a certain neighborhood, or that costs a certain amount of money, you want to consider, how much debt do I have? You want to have as little debt as possible. I'm talking about student loans, I'm talking about car loans, I'm talking about credit card debt. They're going to factor all of that in and say, okay, this is this person's obligations. This is their monthly obligation right now. So we're going to take that $300 payment that they have going towards their car loan. We're going to take that $100 payment they have going towards their car insurance, or $200 payment they have towards their car insurance. We're going to take that $50 a month credit card payment and add that to that student loan, that few $100s that you're paying a month towards that, and we're going to combine that. And before this debt, they could have qualified for $1,500 worth of a mortgage payment. So we're talking about a house that's over $200,000. But since they have all these monthly obligations, we're going to deduct that from there, and now they can only afford $800 payment or something like that. So now you might be able to fit into a $100,000 house. So that wasn't a real example. That's just to show how it works. It's just to show the principle. So you have this new debt, this new car debt, $300 payment. I mean, you're typically going to find that payments for cars are going to be $300 and up a month. you're rarely going to go to a dealership and get something less than that. And if you do, that car maybe was $5,000. I don't know. But the lower, the lenders, they have to justify why they're lending money in the first place. So if the car is a lower amount, a lot of times they'll jack the interest rate up anyway, so that payment's still going to end up being around $300 or more. So that is an amount that's going to take away from what you could have afforded when purchasing a house. So another thing is that your credit may be superior and you don't have that car loan, and you're going forth and you're going to buy a house. A lot of people run into this mistake where they decide, oh, well, you know, I'm getting a new house, I need a new car too. You need to wait until after. Once you close on that house, once you get the keys to that house, I'm not saying just do whatever you want to do, but in a sense you can. It won't affect your credit as far as the house goes. I mean, you have the house now. But if you do it before, if you do it during the underwriting process, that is going to affect what you can afford. It's going to affect your credit score if you try to get it at the same time. Same thing with furniture or any other thing that you put on credit. Wait until after you purchase that house. If you already have a car loan at this point, try to pay it down as much as possible. The more you pay that debt down, the more they will give you when buying a house. So a lot of people will not tell you this beforehand. They just want you to buy the house. The lender just wants you to buy the house. A lot of real estate agents just want you to buy the house. But what if I can prepare you to get what you actually want? And set yourself up for success versus going into just anything. Then, you know, I feel like I've really helped you. So those are my 3 reasons of why you should not, if possible, purchase a car with a loan before purchasing a house with a loan. All right, so stay tuned for more. Make sure you share this with your friends, share this with your family, and, you know, let's educate the people on real estate.